Hi everyone, this is Alissa Coram with Investors Business Daily and welcome to Investing Strategies. We've got a jam-packed lineup for you this episode as we focus on the continued outperformance we're seeing in the software sector. We're kicking things off with the CEO of leading growth name Paylocity to dig into the expanding business opportunities the payroll and HR software company is seeing in light of the pandemic. Plus, the CFO of Twilio is here to discuss the driving forces behind the game-changing stock action we've seen as of late for the communications software firm. Plus, Nasdaq's chief economist will explain the impact of the additions of Zoom and DocuSign to the Nasdaq 100 and how investors have been using a variety of ETFs to profit during this impressive rally. And the fun doesn't stop there. We'll pivot from the software sector and talk about some popular stocks with Ross Gerber, including Netflix and Tesla, both of which are reporting earnings this month. Investing Strategies starts now. Paylocity earns a spot on IBD's coveted Stock Spotlight screen, which highlights companies with strong earnings and sales growth as well as top-notch technical action. Joining me now to discuss the company's solid financial performance and areas of the business primed for growth is Paylocity CEO Steve Beauchamp. Thanks for joining us today, Steve.
Thank you for having me.
All right, so first off, the company has been able to perform at a very high level for a very long time with quarter after quarter of strong earnings and sales growth. So what do you think is the biggest contributing factor to the company's impressive financial track record?
Yeah, I think there's two big factors. And I think one is really our focus on our customers and our level of partnership that we create with our customers. Great example is helping them through all the legislative changes with the CARES Act and getting PPP loans. And we've really done a great job helping our customers. And the second thing is really focusing on technology and really creating innovative software that allows our customers not only to manage all the HR functions, but really to connect and engage with their employees in a much more modern fashion.
Yeah, so speaking of connecting and engaging with employees, now is a time to do that more than ever. So crucial. And for many businesses, the coronavirus pandemic has presented challenges as well as opportunities. So let's talk a little bit about how the pandemic has impacted your business and how demand has changed among your customers during this time.
So first and foremost, we have over 3,000 employees that support all of our customers and create our software. And about 50% of those employees actually work from home for many, many years. And so we had to quickly deploy the rest of the 50% so that we're virtually 100% remote workforce. And we've been able to do that pretty effectively. And at the same time, we get a lot of questions from our customers on how to be able to connect with their employees in a virtual environment. And so we see a lot more customers using tools like surveys and constantly listening to employee feedback. We see them use our community platform that's really a social media kind of platform within just the company. So they can post news announcements, they can connect with employees, they can react with emojis, they can comment. And so we're seeing a real big increase in utilization of learning products, survey products, as well as our community products, because people are really trying to connect with their employees in ways that they don't have a lot of experience with, because a lot of our customers are just not used to operating in a remote environment.
Yeah. And with those different products that you mentioned or otherwise, what area of the business do you think has that biggest potential for growth due to the pandemic? And also, how sticky do you think that will be once, the pandemic eventually subsides and it's back to business as usual?
So I think a lot of these trends were already happening, and what we've seen in the pandemic is they start to happen at an accelerated rate. So people were often having flexible days at home. People were often creating companies where they have a bunch of small locations instead of being in one large location. And you already saw a lot of increase in interviews like this or meetings via Zoom or WebEx or whatever technology somebody wants to be using. And so when you see the younger generation become a more dominant share of the workforce, with millennials getting in decision-making positions and Gen Z entering the workforce, I think a lot of this was already happening. And I think the pandemic will absolutely accelerate that. And as we come out the other side of this, you're going to see it much more common for businesses to operate a significant part of their operation completely virtually.
Yeah. And in particular, is there any specific function that you're seeing that you expect to have a big impact on the growth of the business moving forward with your customers connecting with employees in new ways in an accelerated manner?
Yeah, I think if you look at our business over the last many years, it's mostly been about automating and saving our customers time and getting access to information for employees and managers. And that was really the primary reason somebody would use our platform. As we move forward, they're looking for different ways to engage with their employees. So as an example, we made an acquisition of a video platform that we're in the process of embedding all the way throughout our suite. So people are really much more comfortable offering reward and recognition instead of an email or something like an impression, which we call it, which is a badge that you would use in our platform. They're going to do it with a video journal, and you'll be able to record a video and say, hey, great job in that meeting, really appreciate that. Or you might send your manager notes within our platform via video rather than doing that in person. And so I think the overall comfort level of people actually communicating via video should increase dramatically, and you'll see things like email utilization, I think, start to decline.
And so you mentioned that acquisition of the video platform. When it comes to your strategic initiatives, how do you prioritize the various means of growth, whether it's acquisitions or, expanding new product offerings and expanding the customer base through organic growth or even mergers? How do you prioritize those?
Yeah, the great thing about our business is we interact a ton with customers, so we get a lot of feedback. We have over 20,000 clients across the country, and so we get great ideas by talking to our customers. Sometimes it's our salespeople, sometimes it's our service folks, and then other times we actually use the data that we see across our platform in terms of how clients are actually using our products. And so in many ways, one of the reasons that we launch new products is we identify use cases within our clients and things that they're actually trying to do. And then we try to create products that really make it a lot easier for them to accomplish that. And so, for example, we decided to buy a video product because we saw a lot of our clients using our learning solution, not just for formal courses, but actually sending short little videos to other employees to teach each other things that they were learning on the job. And so we started to think, well, there's really an opportunity to be able to embed video into all sorts of employee lifecycle tasks. And that drove us to do the acquisition with video. So I think it really comes down to listening to our clients and finding problems they're trying to solve and creating innovative solutions to help them solve those problems.
Well, Steve, congratulations on what Paylocity has achieved, and thank you so much for your time today.
Thank you very much. Have a great day.
And coming up after the break, we're joined by the CFO of Twilio. Back in a minute.
Good morning, everyone, and welcome to IBD Live.
Okay, here we go.
Twilio's software connects consumers with some of the most well-known brands out there, including Netflix, Spotify, WhatsApp, Uber, and Airbnb, just to name a few. Here today to fill us in on the driving forces behind the communication software company's growth and what's ahead is Twilio CFO Khozema Shipchandler. Thanks for being here today, Khozema.
Hi, Alissa. It's a pleasure to be with you. Thanks for having me.
All right, so consumers are using Twilio's software perhaps without even realizing it. So how has Twilio been able to strike deals with so many leading companies, and what do you think that says about Twilio's value proposition?
Yeah, Alissa, I think it really speaks to the broad-based strength of the company. And, we serve businesses that serve consumers, and I think what we found is the company was built for this moment. And with all of the kind of angst in the broader backdrop, we approach it with a lot of humility, but at the same time, I think we find that there's a need for cloud scale, there's a need for software agility, and our company was built for this moment, and we're fortunate to be able to deliver products and solutions that serve that.
And looking at the last quarter, there's no doubt that it was a game changer for the company, at least in the eyes of investors, with the stock surging a whopping 40%. The session after the earnings announcement in early May, putting it back at all-time highs, and the stock has just continued to climb higher from there. So what about that quarter, in your view, was game-changing for the company?
Yeah, I think a couple things happened. I think one of them was, as we pointed out on our call, that we had a few industries that were a little bit down, right? So we talked about ride sharing and hospitality, for example, and I think what investors underestimated perhaps was the broad-based strength of the overall company, and so perhaps over-rotated to some of the impacts in some of those industries a little bit more. I think on the flip side, what we also saw was that there were certain use cases in some particular verticals that really took off. And so I'll just give you a few examples. For example, healthcare is one use case. I think this is an industry that has had a long-term desire for digital transformation, and now is finding that it's part of a secular shift that we think has a lot of legs. I would say e-commerce is another very similar industry. You know, we're all watching retailers go through some difficult times, but many have also been able to pivot and use digital communications as one of many vehicles to engage their consumer base, to be able to drive, you know, great outcomes for their consumers. Education, philanthropy, these are some others that I think have also been, you know, positively impacted as a result of kind of this you know, pandemic and tragedy that's in the background. And you know, we're happy to be able to help our customers be able to serve theirs.
Now, what's the strategic process like in terms of making further inroads in some of these newer verticals?
You know, I wouldn't say it's all that different, really, in many respects. You know, when we started the year, we laid out some investment principles that were important for us. In fact, when we released our Q4 earnings, we talked about taking an operating loss, you know, as a company in the current year. And we talked about the desire for us to continue investing in our Flex product, which drives contact centers. We talked about continuing to invest in our go-to-market capabilities, especially around enterprise businesses. And we also talked about the need to continue making investments in some of the more boring areas like systems and process so that we could scale the company. And I wouldn't say that as a result of anything really over the last 12, 14 weeks, there's been a marked change in our investment approach or the way that we've reacted to the moment. I think, as I said earlier, the company was built for this moment, and you know, we're lucky to be able to leverage some of our strengths while again approaching it with a tremendous amount of humility.
And you're talking about investing a lot. So in terms of driving the business forward, are those investments coming down to build or buy? How do you look at the mix of how you're growing your company?
I would say for the most part, Alissa, we're a build company. You know, we fancy ourselves as builders. If you hear the way that we talk about ourselves actually inside the company, we would call ourselves very much a build culture. And so the vast majority of what we're doing is organic. That said, we have a very strong balance sheet. We have about $1.8 billion of cash on that balance sheet, and we have earmarked that for opportunistic M&A. Obviously, I can't get into anything that we're thinking about right now, but if the right set of assets came along that we think would further some of our ambitions in some of the markets that I've talked about, I think we'd certainly pounce if we found the right opportunity.
Okay, well, like many other companies, Twilio decided to withdraw its full year guidance given how dynamic things are right now, as you mentioned, with the coronavirus pandemic. But your CEO, Jeff Lawson, did say on the Q1 conference call that, quote, "We're as excited as we've ever been, if not more excited." So what's exciting to you about the company's long-term outlook?
Yeah, so I would certainly underscore Jeff's enthusiasm and optimism about the company. As I look out beyond the next few quarters, what I think is particularly exciting, I would break down maybe along the lines of use cases and verticals. I think, you know, the single most exciting thing probably is that as some of these industries that I referenced earlier, healthcare, education, e-commerce, I think these are going to be industries that had always wanted a digital transformation to ensue and have now found their moment. And I think they're going to be very resilient use cases over longer periods of time. And then I think at the same time, some of the impacted industries will probably find that they end up coming back. I can't call exactly when that is, but when you think about things like ride sharing and hospitality, there is a day that those are coming back, and we think those are going to be very resilient. So in terms of kind of industries, that's what I'm excited about. The other lens through which I would approach it is this, that we have this contact center product that we call Flex. And I think today there's been more energy and more enthusiasm about that product than we've ever seen. And you can probably understand the rationale for that. You've had businesses that basically overnight had to go from running an on-prem contact center environment to a work from home environment, just like you and I, and running a contact center in an on-prem environment while everybody's working from home is just very, very difficult. And so you bring something that's got the cloud scale that we've got with Flex, it's just really hit its moment. And I think it may not necessarily alter sales cycles, and I think we're going to stay the course in terms of our investing, but we're just seeing a lot more enthusiasm around that particular product set. And I think what that allows us to do is approach the market not just from communications, but also through the perspective of customer engagement, which I think is really where we can help our customers.
All right. Well, we'll definitely be keeping an eye on Twilio here at Investors Business Daily, but we've got to leave it there for now. Khozema, thank you so much for your time today.
Thank you. Appreciate it.
And up next, we're talking to Nasdaq's chief economist about recent software additions to the Nasdaq 100, as well as software sector ETFs. We'll be right back.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Now, software sector high flyers Zoom and DocuSign were recently added to the Nasdaq 100, replacing Willis Towers Watson and United Airlines, respectively. Here with me now to discuss the significance of this, as well as how investors have been utilizing ETFs to profit during the historic market rally, is Nasdaq chief economist Phil McIntosh. Thanks for being here today, Phil.
Thanks for having me.
All right, so Phil, what makes this recent shakeup to the Nasdaq 100 significant in your view?
Well, I think it's kind of interesting because you can see a lot of the companies that are really well positioned for working from home have done very well in the coronavirus period. Even before those two companies got added, we saw the Nasdaq 100 index was outperforming other large cap indexes by 10 to 15%. It actually got back to all-time highs recently. And that's because of companies like Netflix. It's because of companies like Microsoft and Amazon that are all really well positioned for us working from home in the future.
Yeah, and Zoom and DocuSign in particular, with those being two younger software names. When it comes to the mix of names that are in the NASDAQ 100, do you think that perhaps these two recent additions might give us some line of sight to what we could expect in the future as the software sector continues to grow?
Yeah, so the NASDAQ 100 index itself is by definition our listings. So it's NASDAQ listings, which are a lot of new economy listings and a lot of tech companies, also a lot of healthcare companies. So Gilead, which is doing vaccine research, is part of the NASDAQ 100 as well. And so you can kind of see that the mix of new economy companies is helping drive everything forward. And not only that, but you're in the NASDAQ, we don't have financials by rule. And we also don't have so many energy and material companies, which have held a lot of the other indexes back. So to your point, you can really see the sectors that have been hurt by coronavirus, energy complex, materials, a lot of the old school companies have been excluded from the NASDAQ 100 because of the way it's put together. And a lot of the tech companies and healthcare companies that are really well positioned have been helping it to outperform.
And the NASDAQ 100, you could obviously get exposure to that in ETF form with QQQ. What have the inflows been like for that fund during this whole coronavirus pandemic and all of the volatility that we've seen over the last couple of months?
Yeah, so the NASDAQ 100 or the Q's ETF actually passed $100 billion of assets, and that's a mixture of its performance and its inflows, obviously. But for us, that was a milestone, and it's a lot higher than it got in the tech bubble 10 or 15 years ago. So we're pretty proud when it passed that mark. It's a pretty decent-sized ETF. It's also one of the most liquid ETFs in the US market, trading billions of dollars every day with a really tight spread. So it's one of those ETFs that's often used for hedging, for trading, and for really short-term and longer-term investment trends.
Yeah, seems pretty flexible. And back to the software sector in particular, the strength in that group can be underscored by the performance of software ETFs like CLOU, WCLD, and SKYY, to name a few. So walk us through what you're seeing at this time in terms of inflows for those funds.
Yeah, so it's actually been really interesting if we rewind back even to March. So you can see once the coronavirus hit, a lot of the flows in ETFs. I mean, ETFs spiked to 40% of all the value trading in the stock market. And that's because hedge funds and retail and a lot of insurers and hedgers all get in and use the ETFs because they're cheap, easy ways to equitize. But the first thing we saw was a lot of outflows, whether it was in equities or bonds. And then you saw people pivoting, to your point, into some of these new economy ETFs. So there is a huge amount of thematic and factor-based ETFs out there now. And we saw a lot of flows into cloud online retail, innovator funds. And we also saw inflows into some of the healthcare and biotech ETFs because they were positioning for people working from home for quite a long time, and obviously investing in companies that had exposure to the vaccine research and some of the potential success stories that you might get from there.
Yeah, it sounds like there's a lot of tactical moves happening right now in the ETF space. So what else stands out to you right now about the different ways that perhaps growth-oriented investors have been able to successfully utilize ETFs to profit during this historic rally?
Yeah, so one of the really interesting trends is that large cap growth funds have outperformed. They've been outperforming for years, but they outperformed even more as the coronavirus sell-off happened. And what we've actually seen is a couple of periods where we saw the coronavirus cases pick up and people start to worry. That trade flipped, and you saw a lot of the growth and value ETFs, a lot of trading in the large cap and small cap ETFs, and you saw weeks of outperformance and then underperformance. So people have been using those ETFs to position for growth and position for the large cap outperformance that we've seen as well.
All right. Phil McIntosh, Chief Economist at Nasdaq, thanks so much for joining us today and breaking all of that down for us.
No worries. Thanks for having me.
And when we come back, we're analyzing some popular stocks, including Netflix and Tesla. That's after the break.
I'm Arusha Pierce, and welcome to Investing with IBD. Every week, we are going to give listeners insight on how the market is doing. We'll identify stocks or ETFs that are worth considering and adding to your watch list. Not only do we have investing experts, we like to bring on business leaders. The response from listeners has been amazing. It really feels like we're building this community. Join me every week as we take on the market. Listen and subscribe wherever you get your podcasts.
Netflix and Tesla are two popular stocks making notable moves as of late. So let's analyze the stories behind the stock action with Netflix and Tesla earnings around the corner. Ross Gerber, CEO of Gerber Kawasaki Wealth and Investment Management, is here to weigh in on those two names as well as Disney. Hey, Ross, thanks for being here.
Thank you.
All right, well, let's start off with Netflix, which is a big beneficiary, of course, of the stay-at-home trend. It's known for its strong pipeline of original content. And it seems like they're still the clear leader here in the streaming space. So what do you think they need to do to maintain that leadership?
Yeah, it's funny because what I thought Netflix needed to do a few months ago now doesn't matter anymore because the theater business looks like it's going to be shut for some time. And even when it's open, it's probably not going to be that lucrative. So it turns out what I thought was originally Disney's strength in the business model, having the bricks and mortar diversification, is now Disney's weakness. But for Netflix, it actually works perfectly. So there's two things really working for Netflix right now. Number one, the fact that production in Hollywood is pretty much slowed down to a stop. Netflix had invested so much money on content for the future. And at the time, it just seemed like a lot of cash flow being spent. But now they have content for the next year or two that's already done. And it really puts them in the driver's seat, as many of their competitors just simply don't have new content like HBO Max. Disney's not in that situation. But I think because everybody has so much more time to watch things now, that both Disney Plus and Netflix are big winners right now. But especially Netflix, because the content has been excellent. So that's number two. It doesn't matter if you're in the pole position if the content isn't good. The content's been excellent on Netflix over the last 3 to 6 months. So we're expecting just a really good year for them.
Does it concern you at all, though, that management said in the last quarter that it was a little bit cautious about subscriber growth in the back half of the year due to huge gains getting pulled forward earlier in the year?
I don't think any CEO knows what's going to happen. And I think that was under the assumption that things would, I think we had this assumption this would be a 3 or 4 month event, and by fall we'd be back to our normal lives. That is not going to be the case. And so I think any assumption that we're going to go back to, say going to theaters and bars and concerts where it would take our eyeballs away from Netflix is gone, I think, for the year. So I think that assumption is incorrect right now. I think we're all stuck watching Netflix for the rest of the year. And I see them adding more subs than they've ever added in history.
Yeah, well, only time will tell. We'll have to see with the next quarterly report. But elsewhere in the content space, let's talk a little bit more about Disney. Definitely another popular, widely held stock out there. But the stock has seen much better days. And it really was Disney Plus that was the driving force behind Disney's impressive stock gains in 2019. But it's Disney's parks business that's squarely in focus for investors because of the coronavirus pandemic. And it's not looking too great right now on that front for Disney.
No, and I'm a huge Disney bull, and I've been a shareholder my whole life, and I love not only the parks but the content and just Disney. And that being said, they have half their businesses going great. Thank God they went direct to consumer with digital, and thank God they took over Hulu, or else they'd be in real trouble. But the sad fact is that they make a lot of money in parks, cruise, and resorts, and I just don't see that getting back to normal till next year, and I'm hoping by next summer, and that's a hope. And so, it saddens me to say that Disney's going to have to kind of struggle through the year and then hopefully get back on its feet as soon as possible. So we've moved from a buy to a hold on Disney. But I also think management's great, and they have the capital, and they've got this great business now that's growing way faster than what anybody thought. And Netflix is valued more than all of Disney. And so if you really look at Hulu and Disney Plus, and then all the other assets, Disney is a very cheap stock right now if you think out a couple years from now. And they're going to get a great head start in streaming now.
But the parks business, like you said, it's not very clear at this time when that's going to improve. So what signs do you think investors should be looking at? You're saying it may not be till next summer. So right. Is this a type of business that we could be, waiting for a vaccine for things to meaningfully improve, even though parks are expected to reopen at least a little bit this summer?
Yeah, this is so hard for me because I consider myself a fun person, and I love going out. I'm in the music business too, and seeing all my musician friends and myself idled for who knows how long. And these, even for small venues, are struggling with the idea of having 20 or 30 people. So imagine trying to run a venue with 20,000 people a day and 10,000 employees.
Yeah.
It's impossible for people not to get coronavirus in that environment. So I think that we're going to be dealing this for some time to come, and large gatherings and things like Disneyland are going to be real tough to have open and safe, despite, I think, the demand for it, when especially people have not been, covering, using masks and using common sense in their behavior. So we're going through a stage now in America that it's in entertainment, or whether it's shopping or anything else, is that we're all going to be using digital solutions from the workplace to everything else for the time being. And then when things get better, I think a lot of these things are going to continue.
Okay, well, now let's shift gears here a little bit. Tesla has seen big gains during the market rally, and it's been an incredibly strong stock. And it's also one of the most hotly debated companies out there. So what do you think Tesla is doing right at this time?
It's a real good feeling being me right now, because a year ago, the stock was, in the 200s, low 200s, and getting battered, and Elon was mired in issues, and the SEC and short sellers, and now he's getting, 10-year anniversary articles. He was in the cover of Barron's CEO, top CEOs. And boy, it's amazing the difference a year makes. Tesla's done a lot of things right, but I think what's really working for Tesla are trends that are bigger than Tesla. Number one, it's climate change. People in the world want an alternative to gas-powered or ICE engines that are destroying the environment. And we all know that the solutions exist for climate change now. Right now, as of today, between solar, renewable energy, batteries, and EV technologies, there's no question we can reverse the effects of climate change in the next decade. But we have to implement things like electric vehicles and an infrastructure of batteries like what Tesla's doing to succeed at this. It turns out there's no competitors. So Tesla doesn't have a competitor, and they are the only company making EVs in mass and scale, batteries in mass and scale, and now soon to be solar in scale. And what a opportunity over the next decade. So Tesla's just getting started, and they're going to have a globally dominant company over the next decade. And I think investors would be making a big mistake to miss this one. The second thing is being a digital business. I just bought a new Model Y for my wife. The entire process can be done on your phone, from getting your insurance, getting your car loan, picking up your car. You just drive up to Tesla, you get in your car, you check in, you get in your car, and you leave. I've never experienced anything like this in buying a car. And in fact, most people would argue that buying a car is one of the worst experiences they can have as a consumer. So Tesla has this huge advantage that none of its competitors can sell a car over the internet or over the phone. So if you're worried about COVID and you don't want to go to like test drive cars at a dealership, Tesla's your solution. And so I think a lot of people just really like the technology of being able to buy a car with your phone. And that's really helping Tesla. And not to mention, they're now delivering globally, and everybody in the world cares about climate change. And now Elon Musk, especially after launching humans into space for the first time from American soil in over a decade, has become an even bigger iconic folk hero for the Gen X generation. So, I'm buddies with it. I love Elon, and I'm super happy to see him doing so well and the company doing so well, and of course for our investors as well.
Now, you touched on deliveries. That's, of course, another key metric here for investors in addition to profitability. So taking a step back and looking at deliveries over the next couple of quarters, perhaps, or into the next year, what ideally would that look like for Tesla, and what should investors keep an eye out for on that front?
So, with Tesla, they're still going to have to deal with macroeconomic issues like everybody else in every business. And so we're just not sure what we're going to look at the economy in 6 months, and it'll affect Tesla as much as it'll affect Microsoft or anybody else. So the issue with Tesla, to their advantage, is people switching from ICE to EV in great numbers and not having other choices than Tesla. So that helps Tesla. Right now, Fremont's back up and running, and assuming that there isn't a disruption between Shanghai and Fremont, they can make well over 500,000 cars a year, and that's what they were planning on before the pandemic. So they're currently constructing the Gigafactory in Berlin, and they're looking for another site. They're expanding China, and they're looking for another site. It looks like Austin, Texas. So Berlin won't be up for another 2 years, but Shanghai is growing very rapidly right now in its production and size and scale. So I think for the quarter, it's going to be very interesting to see what Tesla's able to deliver, because the Chinese factory was able to get up and running a lot sooner than the US factory. And so for the first time, we can really see some China sales that maybe helped offset the loss of US sales for that month. But I think when you go out into Q2 and beyond, with both factories up and running, Tesla can get on track to delivering over 100,000 cars a quarter. And that's what they need to do to be profitable and to continue to grow the business. And so we expect that 100 to 125,000 cars a quarter in Q2 moving forward. But once again, it's so hard to see what economics are going to be in 6 months, for example.
All right. Well, to cap things off here, Ross, if you could give Elon Musk one piece of constructive criticism, what would it be?
Get a real name for your baby. It's unbelievable. No, it's unbelievable to call your kid X and AE72R. I get it. But this kid has to live with this name, Pick a name, Ben works, or Steve, and stick with it. So that would be my advice.
All right, we'll have to let him know, or you'll have to tweet him.
He watches my interviews, I think, so he might see it.
Okay, well, good. All right,
Yeah.
Well, we've got to leave it there for now. But thanks so much for your insights today, Ross.
Thanks for having me. Appreciate it.
And thank you all for watching this episode of Investing Strategies. This is Alissa Coram for Investors Business Daily, and we'll see you next time.